Hello and welcome back to the COPA video series. I'm Greg Davis, founder of D3 Energy. Thanks for spending a little time with me today. So I want to talk to you about the new era in our oil and gas industry today. And that is the era I've been talking about, the era of conventional, of companies going back into known, conventional, historically productive areas, buying oil fields, and then using new techniques, whether it's horizontal drilling, fracking, data analytics, and developing all that oil and gas that is remaining because it's never been developed using modern drilling techniques. And why do I say it's here? Well, everybody is talking about the acquisition by Chevron of Anadarko, that they're buying Anadarko, and this is going to set off a wave of acquisitions and mergers, which it will, but that is because the shale and oil and gas core trends, like in the Permian and other areas, are essentially now off limits to mid-size and small-size companies. Why? Because you have to have a giant balance sheet, a bunch of money that you have in the bank account, that these oil companies have in the bank account, like a Chevron and these big integrated majors, to be able to withstand, spending hundreds of millions of dollars before they get a drop of oil back to develop these plays. And basically, like in the Permian Basin has become one giant oil field that is only going to be available to the majors. And you'll see more consolidation, but that's no surprise. The reason is, it's only for these big companies who can afford to do this. Plus, they're going to go in and control all the services. So if you're a mid-sized or small company, you might still be able to drill a well out there, but good luck finding rigs, good luck finding frac crews, and good luck getting a decent price. Companies like Chevron will say, look, frack 1,000 wells for us over the next couple of years and we'll pay you X, and their prices will be far lower than a mid-size or small company. So now what's happening is the mid-size and the smaller companies, and we're seeing it now, are going back and they're trying to buy production. Recently there's been some asset sales of some fields right around in an area where D3 has been studying, and there was multiple bidders on these assets because they're trying to buy production, conventional production, that has the potential to drill more wells in it. These companies can go in and exploit not only the existing production and optimize it, but drill new wells and then start applying new techniques and start finding more oil and gas. So competition is heating up for conventional assets, and companies are realizing the only way to survive in this world today is to get out there and go back, start buying, start drilling, start exploring again, because these other areas are off limits. And here's the other thing, the cost of capital. What fueled the shale trend was low cost capital and shareholders willing to, buy into bond offerings and buy stock and fuel all this shale drilling. Well, that party is over. So that capital is not available, and investors are demanding to get returns. They're no longer willing to sit and wait for a big sale or a merger 5 or 10 years from now to get a return. In fact, the stock prices of a lot of these companies, these shale play companies, these shale only companies, have been going down relative to the average S&P companies that have been going up. So oil and gas stocks have been underperforming, and investors are saying no more. The other thing is they're looking at these big shale companies and seeing that the capital going in, the cost of just managing these companies, the money going to management is like 20% of their revenue. And they're saying that's ridiculous. And there are companies now laying off senior management and cutting costs because investors are saying, we're not going to stand for 20% of the revenue going to the executive suite. Conventional is back. Conventional is back. It's happening now. And like in these areas that we have been studying at D3 Energy, and we have many really solid fields that we can acquire in these conventional trends with low-cost recompletions, redevelopment, and drilling within these fields, holding HBP acreage, and we have hundreds, if not thousands, of locations to start growing and building. And the payouts on these wells are quick, within 9 months to a year, as opposed to a shale well that could cost $10 to $15 million and could take a couple years to pay out, and will ultimately flow less oil than what we can get out of some of our wells for a fraction of the cost. So it's happening right now. And yes, this is going to be the era of consolidation. You're going to see more majors buying mid-sized companies. And the reason is you can't be a mid-size or a small-size public company just operating in shale and expect to have investors sit around and wait for you to sell. It's just not going to happen. Services aren't available, and it's only for the big guys. So more activity to come, and I'm looking forward to this era developing and taking root, where companies are realizing we can go buy production, we can make money on that production, and we can drill wells, low-cost wells, and have a mix of opportunities, from recompletions to vertical drilling, trying horizontal. And it's happening now, and it's exciting to be a part of this. And if you're an investor out there, you should be demanding that, you know, the money that is going to the executive suite should be a small fraction of those dollars that are coming out per barrel. It should be very, very low. It shouldn't be 20 or 25%. And you should be demanding to get return of your capital as you go along, and not waiting 5 years, 10 years for a company to sell to a bigger company. Chances are that won't happen. Thanks for spending a little time with me today, and I'll be back again. Greg Davis on behalf of COPA. Thanks.